A historic moment when you look at whether the Federal Reserve or the BOE this morning. Two main issues, inflation versus growth. Are we past peak hawkishness? Your take.
Good morning. Thank you for having me. So I'd say for this week, yes, we are past peak hawkishness. I think the market breathed a great sigh of relief when we learned from the Fed that at least the 75 basis points was off the table for now. They're not actively considering it. And that we were given very clear forward guidance around the next couple of meetings being 50 basis points. So I would say for now, we are. But that doesn't mean that the data that's going to come over the course of the month, whether most importantly, the data on inflation, will not lead us to price in further rate hikes. Again, more 50 basis point rate hikes. I don't think we're going to get to a 75 basis point rate hike again anytime soon.
The market reaction to both the Bank of England and the Fed, I think, is fascinating. The market reaction to the Fed was, as you say, relatively restrained in as much as, well, the Fed is going to be relatively restrained, and that seemed to be the green light for stocks initially. Now, stocks are rolling over now, and yields are starting to spike a little bit higher. The Bank of England, despite putting out a double-digit inflation forecast, was taken as dovish because, well, growth is going to be a problem. Gargi, does the market have a good sense of how to read central banks right now?
You know, I was listening to the conversation that you were having with the speakers that came on before me, and I think that the market is trying to determine what is the most important factor going forward. So for the Fed, it's very clear. They are a single mandate Fed right now. They are only focused on inflation, and they're telling us that. They told us that in numerous ways yesterday, that till they see the signs of inflation turning over, they are likely to continue to raise rates into sort of neutral territory. And we can discuss later a little bit around their definition of neutral, which I thought was interesting. I think that right now the market isn't any more or less sensitive than any time in the past. But I think there's this unique nature to inflation, which is so supply driven. And, you know, to Chair Powell's point yesterday, they don't really have the tools to navigate supply driven inflation. So therefore, I think the market's having a harder time, you know, just the moves that we've seen over the last couple of days, deciphering which to focus on. And I think inflation is top of mind broadly across ECB, across Bank of Japan, across BOE, and obviously the Fed.
Gargi, I have to ask you about the currency market. We've seen volatility across markets, but the currency market has really been something extremely unique. That dollar strength picture, you've seen continuous weakness in the yen and in the euro, as you know. You're also seeing weakness in the pound today, looking at 123 on the cable rate. Over at SocGen, Kit Juke says the likelihood of the cable rate dropping below 120 is larger than euro-dollar parity. Would you agree with that?
So I think, you know, to your point, obviously there's been a huge move in the dollar this year. You know, we see within iShares, which is where I work, we're seeing a huge amount of interest in sort of hedged products, especially in Japan yen hedged products. So I would say that investors are pushing back, or at least recognizing that maybe a little bit of value is being created at these levels of the yen right now. And look, our view is that at least in the front end of the curve, so when we look at the 2-year, the 3-year part, I think we're beginning to get at levels that offer a lot of value. Does that mean that the dollar is going to immediately move significantly lower? No, but I do think that at some point we have to come to terms with the fact that more of the move has happened. Especially in the front end of the curve. And at some point above 3% on the 10-year treasury, I think we are probably going to see a little bit of buying come in the fixed income markets as well.
How can we know where we're going if we don't yet fully understand the implications, Gargi, of what is going on in the labour market? The labour market in the States, the labour market here in the UK is unbelievably strong. Until we start to see data suggesting that maybe we're going back towards balance, can we really get a handle on how far these central banks are going to have to go?
I think we heard a little bit about that yesterday, right? So I think this is exactly the point that Chair Powell was trying to make, and I think he did an excellent job of it, where he said that they don't have a specific, VU ratio in mind, so vacancies to unemployed ratio in mind. He talked about that 1.9 number a few times, but it's not as if he's targeting a 1 or a 1.2. What we should be focused on going forward is, looking to see if more and more people are enticed back into the labor market as a result of higher wages. And obviously, we'll get a reading of that tomorrow when we get the payroll print in the morning. But I think that as of right now, what we should be focused on is higher wages, allowing more people to enter the labor market at hopefully levels that, increasing the participation rate. Hopefully we'll see some of that, and wages still remain steady. So I don't think we'll have a clear sense of how quickly that's going to happen. I don't think we're going to have a clear sense very soon around what that V2U ratio is going to look like. But I think if we focus on a few things, if we focus on the participation rate and not just on the headline number, I think tomorrow we may get a slightly weaker than expected number, but let's not get panicked about that. I think we should look at the underlying strength of the labor market, which, hopefully participation will show us that. And obviously keeping the JOLTS backdrop in mind. How many people or how many jobs are still available for workers? How many people are quitting their jobs? And to what extent that portends a really robust labor market?